For years, you've been told that the silver price reflects reality. Every chart, every headline, every market update tells the same story: silver is worth exactly what the screen says it is. But what if that price has never represented the true value of silver? What if the system controlling this market is built to hide what's really happening? Today, we're pulling back the curtain on one of the biggest financial deceptions of our time. From paper markets and institutional manipulation to supply shortages and growing physical demand, you'll discover why the silver market may be far more broken than most investors realize. Once you understand how this system works, you'll never look at the silver price the same way again. When most people check the price of silver, they assume they are looking at the value of actual physical metal. A chart appears on a financial website, a trading platform updates every second, and news anchors report that silver has risen or fallen by a certain percentage. The natural assumption is that this number reflects the amount someone would pay for a real silver coin or a silver bar. In reality, that assumption overlooks one of the most important distinctions in the precious metals market: the difference between paper silver and physical silver. Paper silver refers to financial instruments that are linked to silver without requiring the buyer to own or possess actual metal. These instruments can include futures contracts, options, exchange-traded products, and other derivatives. They allow traders and investors to speculate on the movement of silver prices without ever taking delivery of a single ounce. For many participants, this makes sense because their objective is not to accumulate silver, but to profit from price fluctuations over short periods of time. Physical silver is fundamentally different. It consists of tangible bullion bars, government-issued coins, privately minted rounds, industrial-grade silver, and other forms of real metal that can be held, stored, transported, or delivered. Once someone purchases physical silver and takes possession of it, that silver cannot be duplicated by a financial contract. It exists as a finite asset that requires mining, refining, transportation, storage, and protection. This distinction becomes increasingly important because these two markets often behave as though they are one and the same. The quoted spot price that appears on financial websites is heavily influenced by trading activity in paper markets. Millions of ounces of silver may appear to change hands in a single trading session, even though only a tiny fraction of those transactions involve actual delivery of metal. Most contracts are open, traded offset, and closed long before delivery becomes necessary. Imagine a stadium filled with people buying and selling tickets to a concert. If everyone is simply trading tickets among themselves without ever attending the event, the price of those tickets may move dramatically based on speculation, emotion, or market sentiment. Now imagine that very few people actually show up at the venue to use those tickets. The activity in the ticket market would be enormous, but the underlying event would remain largely unaffected. In many ways, this illustrates how financial trading in silver can become disconnected from the movement of physical metal. The majority of daily trading volume in global silver markets occurs electronically. Sophisticated trading firms execute thousands of orders within fractions of a second. Algorithms respond instantly to economic reports, interest rate expectations, currency movements, and geopolitical headlines. Large institutions may buy and sell enormous positions in a matter of seconds, creating significant price swings without any physical silver changing hands. This environment creates a market where price discovery is influenced not only by supply and demand for real metal, but also by financial speculation, leverage, and liquidity. A futures contract may represent thousands of ounces of silver, yet the trader controlling that position only needs to post a fraction of its total value as margin. This allows very large positions to be established with relatively little capital. Leverage amplifies both gains and losses. A small movement in price can produce substantial profits or significant losses, encouraging rapid trading rather than long-term ownership. As a result, the paper market often reflects the expectations and strategies of financial participants instead of the immediate availability of physical silver. Meanwhile, the physical market operates according to an entirely different set of realities. Mining companies must discover deposits, obtain permits, build infrastructure, extract ore, process material, refine silver, transport it across continents, and deliver finished products to wholesalers and retailers. Every stage involves costs, time, labor, equipment, and energy. Physical supply cannot instantly expand because demand suddenly increases. Silver is also unique because a substantial portion of annual production comes as a by-product of mining for other metals such as copper, lead, and zinc. This means silver output does not always increase simply because silver prices rise. If copper production slows due to weak industrial demand, silver production may decline even if silver itself remains highly sought after. Demand for physical silver extends far beyond investment. Manufacturers rely on silver for electronics, solar panels, medical devices, automotive components, telecommunications equipment, electrical contacts, and numerous industrial applications. Its exceptional electrical conductivity, thermal conductivity, and resistance to corrosion make it difficult to replace in many technologies. At the same time, investors purchase silver coins and bullion as a store of value, a hedge against inflation, and a form of financial diversification. During periods of economic uncertainty, demand from investors can increase sharply, placing additional pressure on available inventories. These multiple sources of demand create a dynamic that is not always visible in the spot price alone. Retail coin dealers may experience shortages while futures prices remain relatively stable. Premiums above the spot price may increase significantly because physical inventory becomes more difficult to obtain even though paper trading continues without interruption. Premiums represent another important concept that many new investors overlook. The spot price is not usually the final price paid for physical silver. Dealers add fabrication costs, transportation expenses, insurance, distribution costs, and business margins. During periods of strong demand or limited supply, these premiums can rise considerably. For example, if the quoted spot price is $35 per ounce, a popular government-issued bullion coin may sell for several dollars above that figure. During periods of market stress, premiums may widen even further as available inventory becomes scarce. Buyers who only follow the spot price may be surprised to discover that obtaining actual silver costs substantially more than the number displayed on financial news platforms. This difference highlights the fact that the paper price and the physical market do not always move in perfect alignment. The spot price provides a benchmark, but it does not necessarily represent the complete picture of what buyers and sellers experience in the real world. Storage introduces another distinction between financial exposure and physical ownership. A paper investment typically exists within a brokerage account. Ownership is represented electronically and transactions occur digitally. Physical silver, on the other hand, requires secure storage, insurance considerations, transportation planning, and personal responsibility. These practical realities are part of owning a tangible asset. Supporters of physical ownership often value the absence of direct counterparty exposure. Their reasoning is that a silver coin held directly does not depend on the financial condition of a broker or another institution in the same way some financial products might. Others prefer paper instruments because they provide liquidity, convenience, and lower transaction costs for active trading. Each approach serves different objectives and involves different trade-offs. Liquidity is another area where paper markets generally have an advantage. Large financial positions can often be bought or sold almost instantly during market hours. Physical transactions usually require shipping, verification, dealer availability, payment processing, and settlement time. The convenience of electronic trading makes paper silver attractive for investors focused on flexibility. However, convenience and ownership are not identical concepts. Holding exposure to price movements is different from holding a tangible asset. Understanding this distinction allows investors to make decisions based on their own goals rather than assuming every silver investment provides the same characteristics. Another factor influencing paper markets is investor sentiment. Expectations regarding inflation, central bank policy, interest rates, economic growth, currency strength, and geopolitical developments can rapidly influence trading activity. Prices may move significantly based on forecasts or anticipated events rather than immediate changes in physical supply. Industrial demand, by contrast, evolves more gradually. Manufacturers typically plan production months in advance, negotiate supply contracts, and manage inventories carefully. Mining operations also operate on long timelines measured in years rather than days. This difference in speed contributes to periods where financial prices fluctuate much faster than underlying physical fundamentals. Recognizing these structural differences helps explain why discussions about silver often become confusing. One person may be analyzing futures markets and monetary policy, while another focuses on refinery output, bullion inventories, and coin availability. Both are discussing silver, but they are examining different parts of the overall ecosystem. Understanding the distinction between paper silver and physical silver does not automatically imply that one market is right and the other is wrong. Instead, it highlights that each market serves different participants, follows different incentives, and reacts to different forces. Appreciating these differences provides a stronger foundation for evaluating price movements, interpreting market headlines, and understanding why the quoted silver price may not always tell the complete story behind the physical metal available in the marketplace. One of the most debated topics in the precious metals market is whether the price of silver truly reflects its underlying value or whether it is influenced by forces beyond ordinary supply and demand. Whenever silver experiences a sudden decline despite positive economic news or strong physical demand, questions often arise about the mechanics of the market itself. Understanding how price formation works requires looking beyond headlines and examining the structure of modern financial markets. The first point to understand is that silver prices are not determined in a single location by buyers exchanging physical bars. Instead, the global price is influenced by multiple interconnected markets, with futures exchanges playing a central role in price discovery. Every trading day, enormous numbers of contracts are bought and sold by institutions, hedge funds, commercial participants, algorithmic trading firms, and individual investors. These contracts often represent obligations tied to silver rather than immediate ownership of physical metal. Many participants enter these positions solely to benefit from changes in price, with no intention of receiving or delivering actual silver. As contracts are opened, closed, transferred, and offset throughout the trading session, the resulting activity contributes to the spot price that investors around the world follow. Because the trading volume in these financial markets can be significantly larger than the amount of physical silver changing hands, prices may react more strongly to financial flows than to immediate shortages or surpluses of actual metal. This is one reason why silver can experience sharp price swings even when the physical market appears relatively stable. Institutional investors often manage billions of dollars across multiple asset classes. Precious metals represent only one portion of much broader investment strategies. When economic conditions change, these institutions may rebalance their portfolios by increasing or reducing exposure to commodities, including silver. Such decisions are frequently driven by macroeconomic models rather than changes in mine production or industrial demand. Interest rates play a significant role in shaping investor behavior. When central banks raise interest rates, higher-yielding financial assets may become more attractive relative to non-yielding assets such as precious metals. As expectations shift, investment funds may reduce commodity exposure, creating downward pressure on prices, even if long-term physical demand remains healthy. Currency movements also influence silver prices. Because silver is generally priced in US dollars on international markets, fluctuations in the value of the dollar can affect purchasing power for buyers in different countries. A stronger dollar often coincides with downward pressure on precious metals, while a weaker dollar can make silver relatively more attractive to global investors. Another important factor is market liquidity. During periods of financial stress, investors sometimes sell assets not because they have lost confidence in those investments, but because they need cash to meet obligations elsewhere. This phenomenon has occurred during several periods of market turbulence when investors sold commodities, stocks, and even traditionally defensive assets simultaneously. Algorithmic trading has introduced another layer of complexity into modern markets. Sophisticated computer systems continuously monitor price movements, technical indicators, economic releases, and trading patterns. These systems execute transactions in fractions of a second according to predetermined rules. A significant move in one market can automatically trigger buying or selling activity in another, creating rapid price adjustments. Momentum strategies further amplify market movements. When prices begin rising, certain algorithms identify the trend and purchase additional contracts, reinforcing upward momentum. Conversely, when prices begin falling, automated selling can accelerate declines. These reactions often occur independently of any immediate change in the physical silver market. Leverage magnifies these effects. Futures contracts allow traders to control large positions while committing only a fraction of the total contract value as margin. A relatively small change in silver prices can therefore produce substantial gains or losses, encouraging rapid adjustments to positions. Margin requirements may also increase during periods of heightened volatility, forcing some participants to reduce exposure regardless of their long-term outlook. Commercial participants use futures markets for legitimate risk management purposes. Mining companies may hedge future production by selling contracts before extracting the metal, helping stabilize future revenues. Manufacturers that consume silver may purchase contracts to lock in prices and reduce uncertainty regarding production costs. These hedging activities are an essential part of commodity markets and contribute to overall liquidity. Speculators, meanwhile, assume risk in exchange for the opportunity to profit from price movements. Their participation increases trading volume and market efficiency, but it also means prices reflect expectations, forecasts, and sentiment in addition to physical fundamentals. Investor psychology frequently becomes one of the strongest drivers of short-term volatility. Headlines concerning inflation, recession fears, geopolitical tensions, employment data, or central bank announcements can rapidly alter market expectations. Even before measurable changes occur in physical supply or industrial demand, prices may react to anticipated future developments. For example, if investors believe manufacturing activity will weaken over the coming months, they may reduce exposure to industrial commodities, including silver. The resulting price decline reflects expectations rather than immediate decreases in consumption. If those expectations later prove inaccurate, prices may recover just as quickly. Media coverage can amplify these cycles. Dramatic headlines often encourage emotional decision-making, particularly among less experienced investors. Sharp price increases generate optimism, attracting additional buyers, while rapid declines create fear and encourage selling. These emotional responses contribute to short-term volatility without necessarily altering the long-term fundamentals of the silver market. Another aspect worth understanding is the distinction between wholesale and retail markets. Large institutional transactions occur under different conditions than purchases made by individual investors buying coins or small bars. Wholesale markets involve standardized contracts, high trading volumes, and professional counterparties. Retail buyers encounter dealer inventories, fabrication costs, shipping expenses, and premiums above the spot price. As a result, conditions in retail markets may differ substantially from price movements displayed on financial screens. During periods of elevated demand, dealers may experience inventory shortages or increased delivery times even while futures markets continue operating normally. Premiums can expand because fabrication capacity, transportation, and distribution become temporary bottlenecks. Silver also occupies a unique position because it functions both as an industrial metal and an investment asset. Industrial demand depends on manufacturing activity, electronics production, renewable energy development, medical technology, automotive components, and numerous specialized applications. Investment demand, on the other hand, responds more directly to inflation expectations, monetary policy, currency stability, and financial uncertainty. These two sources of demand do not always move together. Industrial consumption may strengthen while investment demand weakens, or the reverse may occur. Consequently, silver prices reflect a complex combination of influences rather than a single economic variable. Mining economics introduce additional complexity. Developing a new silver mine requires years of exploration, environmental studies, financing, permitting, infrastructure construction, and operational planning. Even when prices increase significantly, supply cannot expand immediately. Likewise, temporary price declines do not necessarily cause immediate production cuts because mining companies often plan years ahead. Recycling contributes another important source of supply. Industrial scrap, jewelry, electronics, and photographic materials provide secondary silver that re-enters the market. Recycling volumes tend to increase when prices rise, partially offsetting higher demand. However, recycling also depends on collection systems, refining capacity, and economic incentives. Global trade policies can influence silver markets as well. Import duties, export restrictions, sanctions, transportation disruptions, and geopolitical tensions may affect regional availability without necessarily changing global production. These factors sometimes contribute to temporary imbalances between different geographic markets. Exchange inventories receive considerable attention because they provide one measure of available metal within specific storage systems. However, inventory figures alone do not reveal the complete picture of global supply. Significant quantities of silver remain outside exchange warehouses, in private vaults, industrial facilities, manufacturing supply chains, investment holdings, and government reserves. Understanding market structure requires separating legitimate market mechanisms from speculation and rumor. Commodity markets are inherently complex because they combine physical production with financial trading. Large trading volumes, leveraged positions, automated systems, and international participation naturally produce periods of volatility that may appear disconnected from immediate physical conditions. At the same time, experienced investors recognize that short-term price movements do not always capture long-term fundamentals. Economic cycles, industrial innovation, mining investment, monetary policy, and technological development all influence silver over different time horizons. A daily price movement may reflect temporary financial positioning, while multi-year trends often depend on broader structural factors affecting both supply and demand. Learning how these different components interact enables investors to interpret market movements with greater perspective. Rather than assuming every price change represents a direct shift in physical value, it becomes possible to distinguish between financial positioning, macroeconomic influences, investor sentiment, industrial demand, and long-term supply dynamics. This broader understanding helps explain why silver markets often behave differently than many people initially expect, and why price movements sometimes appear inconsistent with headlines focused solely on physical availability.